Welcome back to See Today Business. Bank Indonesia raised the benchmark to 6.25% on April 24, which could potentially impact the interest expenses and debt servicing costs of companies in Indonesia. The Indonesia Central Bank hiked the rate by 25 basis points in a bid to strengthen the rupiah's stability amid global uncertainties and a stronger US dollar. The increase in the BI rate can directly impact the company's interest expenses and overall debt serving costs. However, previously on April the 16th, Moody's maintained Indonesia's sovereign credit rating at Baa2, one level above investment grade with a stable outlook. On the corporate side, Fitch Ratings affirmed state-owned energy company Pertamina's long-term rating at BBB with a stable outlook. Meanwhile, credit rating agencies Fitch and also Moody's have upgraded property company PT Pakuwon Jati Tbk's debt rating in 2024. So now let's talk more about sustaining credit ratings amid high interest rates with Felita, who is the Director and Head of Indonesia Corporates from Fitch Ratings, and she's joining us online right now. Hi Felita, thank you for joining us virtually today with See Today Business.
Hi, nice to see you virtually.
Yes,
Thanks for having me here.
Yeah, glad to have you here. So let me just be straightforward with the high interest rates. How does it impact auto property companies' revenue and profitability, you think, in projections in Indonesia?
Okay, so let me start from auto. So in general, for auto sector, we do expect that industry-wide revenue will weaken this year based on our expectation that the sales volume for auto domestically in Indonesia is likely to be lower this year in 2024. Fitch actually estimates that we will have around 900,000 units of car sales for domestic wholesales, which is down from the 1 million unit we saw in 2023. So we have seen during the first 4 months of 2024 that the car sales in Indonesia is actually pretty weak, where we see that there has been a lower auto sales by around 23%, down to around 260,000 units. And we don't think that there will be a significant jump in terms of auto demand for the remainder of the year, especially when we consider the high interest rates that might actually also lead to an increase or a higher auto financing rates. Now we know that for around 70 to 80% of car purchases in Indonesia are still reliant on a credit financing. And for the profitability side, actually for auto sector, we do think that on net profit basis that might be affected by the borrowing cost. For property sector, we think in terms of marketing sales, the underlying demand is still quite solid because of the lack of home ownership in Indonesia. And we also think that some government incentives such as the VAT rebates will also help in terms of the property demand. But there might be a risk in terms of property growth, especially if you think the rate and interest rates might be translated into higher mortgage rates because home financing is also mostly purchased on credit in Indonesia.
Right. Well, we want to know, how do you assess a performance of a company, because it then will define their approval to get credits from and loans. So how do you assess their performance?
Right. Okay. So perhaps let me start by aligning our understanding in what rating is and what rating is not. So rating basically is an opinion of credit worthiness of a company, and it's a relative credit worthiness of a company. So there are three main important points here. So first one, it's our opinion. Second one, it's about credit risk. So we measure their ability to pay debt in terms of principal and interest. And then the last one, it's relative. So it's not an absolute measure. So we will compare that with peers. So when we say a company is rated at A, that doesn't mean it is a certain probability of default. It's only mean that it has a lower credit risk than the company that is rated at BBB+, for example. Now, how do we assess a company performance? Basically, we would look at two main things. First one is their business profile, and the second one is their financial profile. So for example, let me give an example. If say we are analyzing a packaged food company, when we are looking at the business profile, we would usually look at the sector in terms of competition, how competitive is the sector, where the company is in terms of the market position, what is their pricing power, whether they are able to pass on cost pressure to customer, for example. And then we would also consider, for example, their diversification in terms of products or their diversification in terms of geographical operational presence or end markets. And then when we are looking at the financial performance or financial profile of a company, basically we would assess their ability to generate cash to pay or meet their debt payment obligation, whether that is interest or whether that is principal. So we look at a couple of things, for example, like whether you can generate enough margin or free cash flow to finance your operating expenses, for example, whether that will be enough money to finance capital expenditure for your production capacity expansion, and whether you still have enough money left to cover your debt obligation payment. Other than that, we will also usually look at companies' liquidity, whether they have enough cash to meet their financial a short-term financial obligation and also the financial policy of the company.
Now, given that some companies, or in fact many companies, have not really recovered from what happened and the residue of the pandemic, and now we have rising interest rates impacted companies. How does it impact companies' interest expenses and overall debt servicing costs?
So in general, we do expect that the rise in benchmark interest rate will typically lead to a higher borrowing cost for the issuer or for the companies. But borrowing costs at the debtors or creditors level will also be affected by a couple of other factors. So the first one, it will be affected by the credit profile of that company itself as perceived by banks as the lenders, for example, or investors if we are talking about issuing bonds in the domestic bond market, for example. And then the second one, we will also, the borrowing cost would also be affected by, for example, the mix or fixed and floating debt in the company's debt structure. So companies that has more exposure towards fixed debt will usually be more protected in terms of a rising interest rate. So some companies go to bond market because they would like to benefit from the fixed rate itself, while others that might have more component of floating interest rates, which is typically related to working capital, might be more exposed in terms of a rising interest rates. The other thing is that we will also see that borrowing costs might be impacted by the tenor of the loan itself, whether it's short term, whether it's long term, whether the company has maturity this year that they have to refinance. Because if they do that, they will be exposed to the prevailing interest rates. And it will also depend on the structure of the debt or the loan. So for example, whether the loan has any collateral, any security or other credit enhancement.
All right. Do you see any differences in terms of its credit ratings here in 2024 with high interest rates between the private companies and or the state-owned companies, state-owned enterprises?
Okay. So basically, in assessing different companies, we will consider not only the standalone profile of the company itself, but we will also consider the larger group structure. So whether it's a private company or whether it's a state-owned companies, we will consider those two. So in a private companies, we would look at their parent company as well, which might also be private or non-state-owned. While for a state-owned companies, we would look at them in relation with their relationship with the state. So what we are trying to look at, for example, for state-owned companies is that whether the government has enough incentive to support them. So we would usually assess in terms of their importance compared to other state-owned enterprises for the government, or whether, for example, whether they carry out any roles in terms of preservation of government policy roles, such as undertaking any role to distribute any subsidized products, or whether they are taking any strategic role from the government or strategic mandate, and whether, for example, if, for example, there is a default with a certain SOE, how is that going to implicate the other SOEs, or how is that going to implicate the government cost of funding?
Yeah. Okay, now if you see what happens with the Fed rates now, there are a lot of uncertainties, and how do you think this year affecting Indonesian companies and their credit ratings amid these uncertainties from the Fed?
Okay, so for Fitch rated Indonesian corporates, basically most of them actually are still on stable outlook. So what does this outlook mean? So basically it means the stable outlook means that it is a direction, likely direction of your rating within the next 12 to 24 months. So stable outlooks means that we expect the rating to remain stable for those period. There are a couple of names that might be on a negative outlook, mostly on the property sector. And for the ratings that are on the triple C or B minus, triple C, double C, the lower end of the scale, usually the downgrade risk or the downside risks are higher. So basically those are the distribution, but most of them actually are still unstable.
All right, Felita, thank you so much for being here and speaking with the See Today Business, and hoping to see you again in due course. Thank you. Take care.
Thank you. Thank you. Good afternoon.
We're going for a break. When we return, our daily recap from stock market. You don't want to miss that. We'll be right back.